It has been pretty busy in the bond market in the last couple of weeks. Last week we saw the yields go way up. This week they came in. What was the cause of it as far as you could say? How much of that was safe haven because of the geopolitical turmoil?
Yeah, thanks, David. What a harrowing week in the headlines. But to your point, markets held in there. There was a lot of resilience coming out of the broader S&P 500 in particular. And we do think part of that was driven by this flight to safety or safe haven response. So typically, when a geopolitical crisis hits, you see investors flock towards areas like the dollar, like gold, and like Treasury bonds. So all three of those played out this week, but most notable for markets was the flight to Treasury bonds, which pushed yields notably lower. So as you just showed in that chart, yields had been climbing almost to highs of this cycle just as of last week. And this week they reversed that course. So that brought some much needed relief for broader equity markets. And it's interesting, even though equity markets did end up higher, where did people and where did investors hang out? Well, we really saw outperformance come from the defensive parts of the market, areas like consumer staples, like utilities, some of those interest rate sensitive parts of the market like real estate. So it wasn't necessarily a tech driven or AI rally that we've seen really in recent weeks as well. So more broadly, we'd say this move in Treasury yields was partly a flight to safety response, partly maybe last week was a top in the near term for yields. We certainly heard a couple of Fed officials this week talk about maybe a pause in the rate hiking cycle. We do think there may be some volatility ahead, especially as there's uncertainty around these auctions that are coming up. But more broadly, we think the trend over time could be stability and hopefully a move lower.
So let's talk about that moment specifically. You talked about highs of the cycle and a top. What leads you to believe that maybe that's what we've seen? We also got some CPI numbers that were a little bit high this week, a little hot. We had University of Michigan sentiment coming in with increased expectations of inflation. So what makes you think that maybe we've seen the high of the cycle on the 10-year?
Yeah, it was interesting. The inflation prints were certainly mixed. We had, again, a little bit of a tick higher in headline inflation and, the gradual move lower in core inflation. But even despite the mixed inflation numbers, which normally would have spooked markets and driven Treasury yields higher, we saw a pretty muted response. So Treasury yields were steady. Today, we actually saw another move lower. And in our view, while we do think there's volatility always around the bond market, we do think the Fed and really global central banks may be looking towards a pause. The Fed has already talked about rate cuts in 2024. Now, what are some of the counters to this? Well, certainly the U.S. has incurred a lot of deficits over time, and those deficits will have to be funded. And we've seen that, this week we had a 30-year yield auction. There wasn't as much demand as we had hoped. That did temporarily drive yields higher. And we saw sell-off in the market. So we may get bouts of volatility like that, but we think generally the direction of travel, especially as the Fed, it's very much doing the quantitative tightening now. It's not a big buyer in the bond space, but over time that program may stabilize as well. So we do think over time we'll see central banks kind of coordinate and pause and pivot lower, which will put some downward pressure on the bond yield space.
That's just what I was going to ask about is the volatility in the bond market, and particularly on the long end in the 30-year that we've seen. As you say, there aren't as many buyers because the Fed is out of the game, and there are questions about what's going on with China and Japan as well. At the same time, the supply is really, really large. Are you concerned at all about increased volatility in the bond market, or do you think it's going to settle back down? If why?
Yeah, what we'd say broadly is the environment we really had that propelled a lot of these, growth stocks and risk appetite over the last 10 years, post-financial crisis, was an environment where the Fed was closer to the zero bound and Treasury yields were in the 1.5% to 2% range. When we think about the next 10 years, it could look very different. So to your point, we don't expect the Fed to go back to the zero bound. And we do think Treasuries may remain elevated versus history. So maybe somewhere in the 3% to 4% range. So in that environment, you really do have to think about asset allocation maybe a bit differently. Growth and value, or maybe a combination of both makes more sense. And certainly bonds have a better or more substantial role in your portfolio. You can now get yields. You can now get some potential for appreciation if over time we do get Treasury yields moving lower. That does support investment grade and longer duration bonds as well. So what we'd say overall is while we may not stay at these elevated levels, we certainly don't expect to return to where we saw in the last decade as well.
You're also getting a yield out of cash or cash equivalents like CDs and things like that. Are your clients going into CDs? Because it can be pretty attractive right now, and goodness knows it's pretty flexible. Not much risk there.
Yeah, it is certainly interesting, especially when we get these headlines and volatility, politics, geopolitics. There is this natural response. Should I just hide out in these CDs? They're offering 5% plus. Our response is always, look, they are attractive for now. They have some interesting yields, really what we haven't seen in any time in recent history. So we understand the appeal. But for long-term investors, there's a few risks. One, reinvestment risk. So over time, those yields may not be there. They may start moving lower. So when you have to reinvest those CDs, it may be a lower rate. Two, there's an opportunity cost. And we've already seen the S&P 500 up about 12% this year, even with the volatility. And so, already it's exceeded that 5% or so cash-like yield. And then thirdly, we've seen historically over time, cash relative to really any other asset class has underperformed. So for long-term investors, we would certainly recommend complementing slowly some of that CD cash-like money with longer duration parts of the market with strategic asset allocations, that are aligned to your goals longer term. So that's what gets you to meet or exceed your financial
Quickly
goals
at the
over
end,
time.
do you need to go into bonds and for fear that maybe the Fed's going to start cutting rates?
We do think that there is an attractive opportunity, and really it's compelling versus any time in recent history for that longer duration part of the market in the investment grade space. And usually, historically, that period between a Fed pause and that first cut is your opportunity. Markets start pricing it in very quickly as the Fed starts signaling rate cuts ahead. So we think the months ahead could provide that window of opportunity for bond investors, really like we haven't seen in recent years. And so we do think there's a compelling opportunity for bond investors in the months ahead.
Provided we actually get to that pause.